Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another weekly edition of the Economic Review, this time for the week ending August 5th, 2022. So let's go right into the markets. So the picture that you see here is very likely to be different at the end of the week because we just had a very interesting jobs report, especially in the US, and it's wreaking havoc on the markets this morning. So the story of the markets since June was that we hit minus 25% year to date on the S&P 500 in early June, and then we had a bit of a relief rally, and the expectations that maybe the Fed was about to pivot, be less hawkish, be less on the autopilot, looking to tighten monetary policy. This is the part of the story. So it was the idea that was supporting the market. So now with the jobs report that was just very, very strong this morning, it kind of puts to bed this idea of a Fed pivot. So we're seeing some volatility to the downside on the stock market. The bond market we had a rally over the last few weeks, over the last week or so. The expectations that maybe the Fed wasn't really done, and you had the Fed governors, the Fed speakers coming out saying that you need to be careful to think that we're done. There's a lot of work to be done. That pushed interest rates higher a little bit, so negative returns on the week. And this morning we see more of that. So the next few months will be interesting. The question is not really are we in a recession, or when will we be in recession in the US? We still have as a base case in the US that we will be at some point in a recession over the next 12 to 18 months. Not a big recession, a small recession. We think the odds are about 65%. So it's not 100%, but it is the base case. So, but the real question is, where will growth come from over the next 12 to 18 months? Our leading indicators are pointing towards more weakness. So that's why we think we will be revisiting the lows in this bear market on stocks. For the bond market, there are many stories. It's hard to call right now, but we are being careful in our positioning. Job number one as a portfolio manager is to protect capital. We have a fiduciary role. We need to grow your capital, but we need to protect it first. So when we think that the risk-reward ratio is not very favorable, it's our job to be defensive, but we're not overly defensive either. So if we're wrong and the stock market continues to climb here, well, at least you're going to be participating in the rebound. So we'll delve deeply into the bear market in a few minutes, but here, maybe just looking at the jobs markets on the left, you have the US. So we had a strong beat at 528,000. Market was expecting much less than that. So why is it such a strong signal? Because participation rate is falling, so there's less people participating in the labor market. Businesses are hiring a lot of people, so there's wage pressure. So it shows that the economy, even though should be weakening right now, it is still, the labor market at least is still pretty strong, and wage pressures could fuel inflationary pressures. So the work of the Fed and the work of major central banks around the world is not done yet. So the market was starting to price that maybe the work was done. The work's not done yet, so that means more liquidity will be removed from the markets, and of course that's not a positive sign for risk appetite and for potential growth in asset prices. So on the left you have the US. That was a story. In Canada, 2 consecutive months of negative prints for the job market. Just remember that the Canadian job market rebounded very strongly following COVID. The participation rate is very high. It's one of the highest in the world. It is at historical high too. The high was in March, but we're still very near those historically high levels. Employment rate, same thing. So are we starting to see, just a return of the pendulum to something that is more sustainable, or are there signs that the economy is weakening more than we thought? So it's still a big question mark. We'll be following that for you. We'll brief you on our views as they evolve, but very strong beat in the US and negative in Canada here. So stock market. So since I've been back from vacation, the one question I've been asked 1,000 times, it seems, is is the bottom in for the bear market? Are we back to a bull market now? I mean, is it time to invest? I mean, clear days ahead. I would still be careful. In the US, we're still in bear market rally number 4. You can see that on the left. The TSX, we're not yet in a bear market. We didn't go down 20% from the recent high, which was in April. We're in a rebound too, but we would be careful for a few reasons. So here, maybe, it's not a precise science. It's not like a law of physics, but let's look at what bear markets look like typically. And this one would be a little bit odd if it ended here. So first, before we go to the characteristics of the bear market itself, the recent rally is pretty strong, about between 10 and 15%. We've seen from the lows in June. This is what makes people think that maybe we're done, because it's 10-15%. Well, here what you see on the screen is that the rally that we are seeing now is actually pretty average in terms of bear market rally. So since 1950, all of the bear market rallies that we've seen are there. So in terms of days, and then in terms of percentage, so horizontal is days, percentage return is vertical. So you can see we're right at the average for the number of days and for the strength of the rally. So it's just very average. We've seen stronger, we've seen longer. So yes, it is a rally. It tests your resolve as an investor, but there's nothing special yet about the rebound that we've just seen. If the bear market was over now, as you can see here on those two tables, it would be one of the shortest in history based on a number of days of the bear market. So it would be about the 25th percentile here. So it would be a very short one. In terms of the depth, so in terms of the percentage of the pullback, the drawdown that we've seen, it would be just about average. So there would be nothing special in terms of percentage, because minus 25% is close to the middle, but it would be short in terms of days. So things move faster now. Would that be out of whack? It's a question that is worth asking, but it would be a bit odd. Mostly in terms of capitulation. The next chart is more telling. Typically, when you have a bear market, you tend to have a capitulation at some point. So capitulation means that fear just jumps to extreme levels. And the way to measure fear is to look at the VIX index. So of course, VIX data goes back only all the way to 1990. So we don't have history since the 1930s. And what we're seeing here in this chart, the gray areas are the bear markets. And that typically within a bear market, and you've seen that in 2008, 2009, the capitulation, the big fear, comes a bit late in the bear market. And we haven't seen it yet in the sense that the VIX didn't jump above the level of 45, which seems to be the key for a typical bear market over the last 30 years. So is the capitulation ahead of us? It will this time be different, and there will be no episode of strong fear and capitulation. We'll see, but it would be different from all of the bear markets that we've seen over the last 30 years if it didn't happen. So the key now to the market is this thing here. Will we have a recession or not? On the left, you have the yield curve, which is starting to flag recessionary risks. So we are also of the idea of the result that we will have some kind of recession going forward. But what we did is that we looked at all of the bear markets on the S&P 500 since 1929, since we have good daily data, and we looked at the behavior of the bear markets when there is a recession, so that's the dark blue line, and when there isn't a recession during the bear market, so that's the gray line. So as you can see, the rebound that we've seen recently brings us back in line with the median path of the bear market, and we're just about to see the divergence between the two paths. If there's a recession, that means that we will be testing the lows, going much lower, lots of volatility, and some rallies that are considered bull traps along the way. So we should see that that's likely ahead of us. So the call on a recession is going to be very important. If I'm wrong, and if we're wrong, if there's no recession, well, probably we could stay at the levels that we're at right now, but history suggests that we'd still be going sideways with some volatility until at some point the market just digested all of the news and starts a new bull market again. So the recession call, it is very important to know if we're going to go down or not, but history suggests that we're still not out of the woods in terms of volatility. So V-shaped rebounds are fun, but not every year can be 2020, just when all of central banks and fiscal policy just pushes all of the liquidity in the market and you have a strong rebound. It's not how it typically happens. So we'll see, but again, just food for thought. So what to watch next week? CPI inflation, we had 9.1% in the US in June. Oil prices pushed gasoline prices lower in July, so that means that we could see a slowdown to 8.8, still pretty high. Will June be the top? Gonna be a question will be everyone will be asking, but maybe you could see some respite at least for July. And University of Michigan Sentiment Index, consumer confidence still at the lowest level since the 1950s. So let's see what mood consumers are in. So that wraps it up for the week. ia.ca/economy, your go-to webpage. Everything that I do is there. You can have access to the podcast in your interest if you haven't listened to it yet. I strongly encourage that you do. It's available on our webpage, on Apple Podcast, on Google Podcast, on Spotify Podcast. So it's available everywhere. Little tidbits of information. So it's there for you. Economy Finance 101. There's been some new material recently, and we'll keep posting at on average 1 video a month as long as we have things to say. So there's things there. And social media, Twitter and LinkedIn. Strongly encourage that you give me a follow to continue to stay informed on our views regarding the economy and the markets. So that wraps it up for the week. Thanks for listening, and I'll be back again next week.